Young investors are flocking to social media platforms like TikTok, Reddit, Twitter, and Instagram for financial advice. But is that the best path to solve their financial problems? Let's bring in Ross Mack of Macconomics to discuss. So, Ross, let's get right into this. I think you may be a little biased, but what's your takeaway? What's your thought?
Well, here's what I think. Once again, thank you so much for having me. Here's what I'll say about social media in general, right? I think it is finding a way to just democratize access. For so long, people have obviously thought about talking about finances either taboo or the simple fact is though you didn't necessarily have access to the right information. And I'm not going to necessarily say everyone on social media is disseminating the right and the accurate information, but what it is doing is starting to have a conversation. And the younger you actually start speaking about it, I think obviously the better it will be long term.
Yeah, Ross, I think a lot of people out there, they do turn to social media, obviously, for financial information. When you take a look at some of these numbers, 52.9 million views to date for the hashtag payday routine. So there clearly is a massive interest in this. How do you figure out who you can trust and who you can't? What's your advice out there to the users other than that they can probably trust you?
Yeah, well, I think what it really boils down to is doing a little more research and digging to actually see if this person that you're following does have credentials. Because what I think social media is doing is giving you the ability to, one, have the conversation, right? Making you say, okay, I didn't know I needed to know about this. And from there, I think everyone can then in turn make a quick Google search, whether it's the actual topic that individual is talking about, or if you're actually doing a Google search for the actual influencer that you're following.
So, Ross, I want to ask you, one of the data points that we've looked at is the number of people living paycheck to paycheck. And you're seeing that nearly 2/3 of Americans still live paycheck to paycheck. So about 60% as of March. So what is your advice on breaking that cycle?
My advice is going to be very simple. You have to control your spending, right? It's when you really see a number like that, most people are going to say, oh, well, maybe it's because, the minimum wage is too low, right? At the end of the day, when it comes to 60% of people living paycheck to paycheck, people making over $250,000, almost a third of them are also living paycheck to paycheck. So it's never just you need to make more money. What you actually need to do is find better ways to actually control your spending, right? Actually hone in what your expenses are. And the way you do that is create a budget, right? Everyone needs to be able to control their inflows and outflows to ensure that they're not living above their means, right? It's obviously one of those things that is not a sexy thing to do, but by truly writing down what your income is, right? Your after-tax take-home pay, you quickly can see if you are spending too much when it comes to dining out, or if you're spending too much when it comes to swiping on your favorite website, that maybe if it's Amazon, right? But at the end of the day, writing it down, having a quick 50-30-20 rule will ensure that you yourself aren't living above your means. And as you can see, the average person is.
Ross, you tackle a number of subjects, and one of these, if you're trying to figure out what exactly your wealth is going to look like in the short term, you got to be keeping a close eye on what's happening down in D.C. You just did a video on this. I'm curious, though, from the traction that you've seen and from what you're seeing, the trends from your followers, are they worried about the debt ceiling negotiations?
What I will say is I think that there will be a deal to get done, right? Historically speaking, this is obviously, a left versus right, a Republican versus Democrat type of thing, and who's maybe going to fold and concede first. But at the end of the day, I think that I would hope that they put the American people first, and I do believe that a deal will get done. And so what I would say to any individual from an investor standpoint is, in the short term, there might be a little volatility, but in the long term, history has always shown that they get it done, right? I think that we'll get it done.
But Russ, I'm curious, though, Main Street, the younger viewers that you have following your platform, do you think they understand or really, grasp what's at hand with this?
No, I don't, right? What I will say is I was an intern in 2011, right? And it was very interesting to even see that. I was at Morgan Stanley interning at the time, and it's very interesting. But what I will say is that the younger generation, I don't think they understand the brevity of what could occur, right? If we were to ever to default, right? If we are no longer making Social Security payments, right? If Medicare is gone, right? I think that at the end of the day, younger investors need to understand that be a long-term investor. You shouldn't deviate from your plans when it comes to dollar cost averaging.
Okay, so Ross, I got to ask you just really quickly to explain. We have a mainstream audience as well. It's not just the Wall Street folks. What is 50-30-20?
Sure. When it comes to budgeting, I find it very imperative that you don't live above your means. And so the way you want to do this is take what you make on a monthly basis after taxes. And the way you determine if you're living above your means is you shouldn't be spending more than 50% of your after take home taxes on a monthly basis, your income. You shouldn't be spending more than on your necessities. The necessities are, think of your rent mortgage, think of your food, think of health insurance, car note, etc. 30% after that, you can spend towards the things that you want to do, whether that is actually dining out, whether that's ordering Uber takeout, that's vacation, etc. And then the last 20% you want to allocate to saving, paying down debt and investing. Right now, the target when it comes to investing is you want to be somewhere around 15% when it comes to retirement planning. So at the end of the day, what you're trying to do is create this plan so you can get closer and closer to your retirement goal so that you can retire and not have to work until your demise.
Yeah, or to live off cat food. Ross Mack, our thanks to you again, as usual.